Is it okay if I test the Ripple's film?
Yes, you may.
Okay.
Firoz, have you started the session? No.
At EY, one tiny question like, is there a better way, may seem a drop in the ocean, but it causes a ripple effect that can spread out to the entire world. Every question we ask can build confidence in the capital markets, can help our clients grow, innovators accelerate, governments solve more complex challenges, and communities to thrive. All of these better questions on a huge scale create long-term value for our people, clients, and society that leads to sustainable, inclusive growth. Every better working answer ladders up to achieve our purpose of building a better working world. So,
Okay, I got that.
Okay, Divyana,
Yeah.
unfortunately, you have started the broadcast. It was supposed to be started at 6, but
All right.
so
Oh,
we'll just
cancel it.
wait for some participants, then we can kick off the session as we have a quite low audience right now. Okay, we'll
Right.
just wait for some participants to join in, and then we can start or kick off the session. You guys, if you guys are in the same office right now, you guys can discuss if there is anything to be discussed. I would recommend to avoid discussing things right now on the platform.
Good evening, everybody. Thank you very much for joining in. I hope you can hear me loud and clear. So I think it's time to begin. Roshni is on the call. Roshni, can I hand over to you for introduction of your team, please?
Yes, thank you, Harun. Good evening, everyone. Welcome back again for another session on tax landscape in Sri Lanka. So today we are going to cover a part of income tax, which is tax on gains on realization of assets, simply known as capital gains. So to do that session, we have three ladies from our tax advisory team. So I'm going to hand it over to them. They consist of Amma, she's a senior manager, Divyana and Sinali. So as always, if you do have questions, please raise them. I think we are going to have a couple of breaks like the last session. So please do raise any questions you have. We are happy to answer them as possible. So over to you, Amma.
Roshini. Good evening, everyone. So let me start by posing a question to you. So just imagine you purchased a land or a condominium property at the beginning of the year in the suburbs of Colombo for 35 million. At the end of the year, you observe that the value in the condominium has appreciated by 5 million. Now it can be sold at 40 million. So the question is, are you liable to tax on this gain? And if so, at what rate? So why am I asking you this question? It is because, as Roshni said, this evening we're discussing tax aspects relating to realization of assets. And we hope by the end of the session today, we'll help you to answer some of these questions. Divyana, can I have the next slide, please? Thank you. So in terms of contents, we will first look at the concept of realization and what constitutes a realization. And then because the tax aspects relating to realization of specific classes of assets are different, first we will move on to identifying what these assets are in terms of investment assets, capital assets, or depreciable assets, and then move on to see how these gains are taxed. Our law also provides specific provisions relating to transfer of assets between associated persons or related parties. And we have specific provisions providing for tax rollover relief and exemption. So we will take you through that and also, of course, relevant compliance requirements. So what is a realization of assets? We kept saying that a gain arises on a realization of an asset. So the first step is to understand what gives rise to a realization. A realization primarily happens when a person parts with ownership of an asset. So that can be by way of a sale, exchange, transfer. It can also happen when a person ceases to exist. For example, upon a death or just before a death of an individual. So a realization needs to happen to trigger a taxable event. That is, it is only after a sale or transfer happens that you can look at the tax impact. So going back to my initial question, even though the value of the property has appreciated, unless there is a transfer or a sale, there will be no tax impact. So basically we're saying unrealized gains or book gains will not be taxed. So a taxable event has to always be triggered by a realization. As an exception to the general rule, we have a few instances where you can still retain the asset, but the law deems you to be realized. This can happen when there is a change of a residence of the individual, or where there's a change in the class of asset, or in limited instances, for whatever reason, the consideration you derive from holding the asset exceeds the cost. So what is a gain? What is a gain? It will be, to put it very simply, it will be consideration minus cost. We'll move on later to discuss this in detail, But for now, going back to my initial question, if you were to sell that condominium at the end of the year at 40 million, that will be your consideration. The cost will be the cost of acquisition at 35 million, which results in a gain of 35 million. And as Roshni also mentioned, this is gains on realization of assets is part and parcel of our income tax regime, and it is applicable to all persons, individuals or companies. Because the tax implications arising in regard to realization of specific assets differ significantly, it is very important that you identify the classes of asset that you're dealing with. So the distinction between investment and capital assets is a very important topic that we need to get it. Viviana, yes, thank you. So what is an investment asset? An investment asset is a capital asset held as part of an investment. The law defines a capital asset to mean a land or building, shares or financial assets, but this cannot include any trading stock or depreciable asset. So to qualify as an investment asset, first you need to fall within the scope of a capital asset, and then also satisfy the requirement that it is being held as a part of an investment. So let's take an example: an individual buying a land from his savings and holding it for capital appreciation, long term. So this land falls within the definition of a capital asset, and it is also held as an investment asset. So this land held by the individual will qualify as an investment asset. Compare that with the property development company purchasing a land. It does fall within the definition of a capital asset. Land is included, but in this case, the land is effectively connected to the business of the property development company. It is not held as an investment. So in that case, it will be a capital asset of that property development company. An important distinction is the rate of tax. Investment assets, gains on investment assets are taxed at a lower rate of 10%, whereas gains on capital assets are taxed at a higher rate. In regard to a company, that with a standard rate of 24%. Some of you may be familiar that capital gains tax was introduced in Sri Lanka from 1st April 2018. So what is this reference to a capital gains tax or a capital gain? A capital gain essentially is another name that we use for gains on realization of investment assets. So if you're talking about a capital gain, you're talking about investment assets and investment income. As opposed to that, if it is a gain from a capital asset, it is trade profit and forms a part of your business income. So as we said, to qualify as an investment asset, let's move on, Divana. To qualify as an investment asset, it needs to first fall within the definition of a capital asset and then qualify to be held for investment. So how do you determine whether an asset is held for investment or otherwise? There are several tests that we use for this. One is the intention at the time of purchase. When you purchased it, were you using it, did you intend to hold it for long-term capital appreciation, or were you planning to sell it quickly and make a gain? Method of financing. In regard to investment assets, they're normally financed through savings and rarely through debt. If you take the holding period, investment assets, because it is held for capital appreciation, is held for a long time. Then the frequency of transaction, the more number of sales and purchases and sales are there, that would indicate a business transaction. Then we also check whether the asset concerned is effectively connected to the business. If that is the case, that would be a capital asset. Let's look at a few illustrations. A is employed at XYZ Limited. He has been employed there for 10 years. He has bought a land with his savings in 2015 for rupees 1 million, which he now wishes to sell. The question is whether the land is an investment asset. He is employed, so he is not carrying out a business. And the land has been bought with his savings, and only one land has been bought. The asset has been held since 2015, that is almost 7 years. All these factors indicate that the land will qualify as an investment asset. So let's compare that with this illustration. He owns 5 plots of land. He has put up buildings in each plot and rents them out. He has hired 2 employees to manage his work. So not 1, but 5 plots of land. He's put up buildings and hired staff. So it looks like it appears he's actively engaged in this activity. He's not holding the asset passively for investment gains. Therefore, it has the characteristics of a business and would be classified as a capital asset. Now that we have identified what an investment asset is, let's go on to see how a gain on an investment asset is computed and taxed. So gain is consideration minus cost. So consideration in this case would be the amount you receive or the amount receivable in cash, or if it is consideration kind, the market value. Last year, we had a series of amendments to the income tax law. So based on this amendment, there was a specific amendment in regard to consideration of investment assets, which says that consideration of an related to investment asset can't be less than the assessed value. What is the assessed value? It could be the value at the time of transfer as given by a valuation report done by a professionally qualified valuer. Moving on to the cost side of things. If it is an investment held as at 30th September 2017, the cost is deemed to be the market value as at that date, as at 30th September 2017. Why is this? Because as I said, capital gains tax was introduced from 1st April 2018. So at the time this law was introduced, the thinking was that only appreciation in value after the effective date of the law should be taxed. So based on this deemed cost, this ensures that only appreciation in value after 30th September 2017 will be liable to tax. If the asset is something that you have acquired after 30th September 2017, then we are looking at the actual cost in terms of acquisition, construction, manufacture, or production, and can even include expenditure incurred on altering or improving, maintaining the asset, and what we call incidental expenditure, that is advertising, transfer taxes, professional fees paid to brokers or valuers, attorneys, etc. But one important point to remember is that this cost cannot include any expense that you've already claimed or deducted in calculating your income tax. And it also can't be a cost which is included in another asset. Let's look at a few illustrations. A 20 perch land, which was purchased in 1991 for 10 million, is sold for 80 million today. The market value of the land as at September 30th, 2017 was 70 million. It is assumed that it is an investment asset. It has already been classified. We know it is an investment asset. What is the consideration? It's the amount you receive, that is 80 million. So in terms of cost, we know it is an investment asset, and we know that the asset was held as at 30th September 2017 because it was purchased in 1991. So the gain will be consideration minus the deemed cost, resulting in a gain of 10 million. So this, as I said, ensures that it is only the capital appreciation of the asset after September 30th, 2017 is being taxed now. The tax rate would be 10%. Next illustration is where 10 perch land, which is purchased in 2020 for 110 million, is sold for 130 million today. The market value of the land as at 30th September 2017 was 80 million. Again, we're assuming that it is an investment asset. The consideration would be 130 million, the amount received. Then what is the cost? We know it is an investment asset, but it is an investment asset which we acquired after September 30th, 2017. So in this case, the gain would be, your cost would be the actual cost that you incurred, which is 110. This results in a gain of 20 million, which will be taxed at 10%. So why is it important to identify an investment asset? Following on from that discussion. It is important to identify for an investment asset clearly because it is taxed at a lower rate of 10%. And also the deemed cost of the market value as at 30th September 2017 is only applicable in regard to an investment asset. So this is something you would really want to keep in mind. Let's move on to capital assets. We have already discussed the definition of a capital asset. So it is land or building, shares or similar financial assets. It cannot include trading stock or a depreciable asset. So here we're talking about whatever assets which fall within this definition, which is not held for investment purpose. Consideration would be similar to investment asset, amounts received or receivable, including the market value of consideration in kind. Cost would be the actual cost because there is no relief of the deemed cost as at 30th September 2017 is not relevant here. In terms of rate, if it is a company, it will be the standard, generally it will be the standard tax rate of 24%. If it is an individual holding the capital asset, it can be taxed at the progressive rates of 6 to 18%. Let's look at illustration. Shares in a non-listed entity which were purchased in 2010 for 100,000 is sold for 200,000 today. The market value of the shares as of September 30th, 2017 was 150,000. Sale of the shares is done by an investment holding company. So here we have not been given a classification, so you have to start by first classifying the asset. So this is an investment holding company selling shares. So trading in shares is something that is effectively connected to the business of an investment holding company. So therefore, this will constitute capital assets in the hands of this relevant company. The consideration would be the amount received, which is 200,000. The cost, yes, we have been given the 30th September valuation, but not relevant here because we're looking at a capital asset. It will be the actual cost that we consider. Resulting in a gain of 100,000, and it will be taxed at the standard rate applicable to companies, which is 24%. We have done a detailed discussion on capital versus investment assets and the method of the gains. Jivanti, are there any questions that?
Yes, Sama. Yes, you have a yes, you have a very good question. You have a very good question from the audience. Sama, I'll read it out for you. How is market value is assessed? Because it is based on estimation, and there is always uncertainty around it. How does tax authority ensures it's an appropriate value? You may answer that.
Okay, thank you, Jivanti. So if it is with reference to an investment asset, as we discussed, as per the recent amendment, there is a specific provision which says how the valuation needs to be done. It talks about assessed value, which is the valuation as per a report done by a professional valuer as applicable to the date of transfer. So if you were to transfer an investment asset and pay tax on that, in the event the tax authorities question you may have to substantiate that with a valuation report. So in terms of what method the valuation report adopts, there is no specific criteria given. So that is why they've said it is a valuation report done by a professional valuer. I hope that would answer your question.
Sama. Yeah, we have another question. Can a business buy a land and then rent it out? So will it be regarded as investment? The company does not do renting business. Can I read it out for you again, Amma?
No, understood. So it is a business which has an independent business income, say manufacturing or exporting. And in addition to that, they decide to invest in a building and rent it out. So in this case, I think if rental business is not their business income, but something additional, if the rental income forms a part of the investment income, the relevant asset will also form a part of, can be classified as an investment asset.
No more questions, Amma.
Okay. So then we'll move on to discussing realization of depreciable assets. So what is a depreciable asset? It is an asset which you are using in the production of income from business, but which is likely to lose value with time. So the gain in regard to a depreciable asset, so depreciable assets are generally what assets on which you would claim capital allowances, which are your property, plant and equipment, your building, your computer equipment, furniture and fittings, etc. Gains would be computed as consideration minus the tax written down value. What would the tax written down value be? That is the cost of the asset reduced by all capital allowances granted for the asset. Any gains in regard to depreciable assets, we call them assessable charges. They'll be taxed at the normal standard corporate income tax of 24% unless a concessionary rate is applicable. Any balancing allowances, if there are any allowance, any losses where the tax written down value exceeds the consideration, they can be deducted when computing the person's income from business. Let's look at a small illustration quickly. Laptops were purchased in 2018 at a cost of 500,000, which was sold in 2021 for 400,000. At the time of disposal, the tax written down value of the laptops amounted to 300,000. Consideration 400,000. The cost in this case is the tax written down value, which is 300,000. The gain would be the difference, that is 100,000, and liable to tax at 24%. This would, however, change if there are any concessionary rates available to the company and the asset, the depreciable asset concerned, is an asset used in that specific business. So the concept of realization has also been extended to liabilities. On a realization of a liability, the law says that there may be instances in which a gain could arise. When do you realize a liability? Generally on satisfaction of the liability. For example, if you take a loan, you pay the loan amount and settle the loan. That would give rise to a realization of that loan. So consideration in this case would be the loan amount that you receive at the very inception of the loan, at the beginning of the loan, and the cost is the amount that you repay to satisfy the loan. Any difference, if any, can result in a gain. In terms of the applicable rate, again, the general corporate income tax will be applicable at the progressive rates for individual. Shall we look at a small illustration? Company A has a payable of 2 million recorded in the books to company B on account of a loan received. Company A transfers shares held in an associate valued at, which is also valued at 2 million. Company B, as a result of which the payable is settled. The consideration would be the initial loan amount that company A received, which is 2 million. Then the cost is the cost incurred by company A to settle this loan. In this case, that will be the market value of shares that they're transferring, which also amounts to 2 million. In this case, the cost and the consideration are both 2 million, resulting in a no tax situation. So as I said at the beginning, we have dealt now with realization of specific classes of assets, investment assets, capital assets, and also depreciable assets. Let's now move on to a section on specific provisions provided in the law in regard to transfer of assets to related parties. The law provides for very special provisions enabling you to defer tax in certain limited instances, and it also provides exemptions from tax in certain cases. So my colleague Divyana will take you through this. Over to you, Divyana.
Thanks, Amma. As discussed by Amma, the transferor will be liable to tax on the gain arising on the realization of an asset, which is computed as consideration minus cost. How
Hi, Divyana.
as Amma analyzed before, the transferor will be liable to tax on the gain arising on the realization of an asset, computed as consideration minus cost. However, the law has specifically addressed the situation where an asset is realized by way of a transfer of ownership to an associated person or transfer to any person by way of gift. That is where there is no consideration. So in these two situations, the market value will be deemed to be the consideration received at the time the asset is realized. And the person who acquires this asset, that is the transferee, will be treated as incurring expenditure of the same amount. What is the net cost? So a net cost of a depreciable asset is the cost minus the written down value of the asset. In the case of any other asset or liability, the net cost would be the market value minus the cost of the asset. The law provides relief in specified instances where it states that the consideration is deemed to be the net cost of an asset. So in these situations where the consideration is the net cost of an asset, there will be no gain arising to the transferor. The first situation will be where there's a transfer of an asset to a spouse or a former spouse on death as a part of a divorce settlement or a separation agreement. The second situation is a transfer on death. This is where there's a realization of an asset upon the death of a person. So principally, the deceased person will be treated as deriving the net cost of that asset at the time of death, and the person who acquires ownership of that asset will be treated as having incurred the same net cost in acquiring that asset. The third situation is where there's a transfer of land or building by an individual to an associate of that individual. So an associate could be the individual's child by way of marriage, adoption, spouse, parent, grandparent, grandchild, sibling, aunt, uncle, nephew, niece, or first cousin. The fourth situation is where there's a transfer of an asset by an individual to a charitable institution by way of gift, that is, for no consideration. Moving on, the fifth situation is where there's a transfer of specified assets to an associate upon meeting certain conditions. The person or the associate, that is either of the parties, the transferor or the transferee, must be an entity. Secondly, the asset transferred has to be one of these four types, that is trading stock, a depreciable asset, an investment asset, or a capital asset of the business. This asset that is transferred has to be a trading stock, a depreciable asset, an investment asset, or a capital asset of the business immediately after the transfer by that person. Moreover, at the time of the transfer, the person and the associate must be residents of Sri Lanka. The associate cannot be exempted from tax, and the assets that are transferred should continue its underlying ownership of at least 50%. Let's move on to an illustration. Let's say there's an individual that gives a land in Sri Lanka to his daughter, and this land was acquired in 1980 for 4 million. The market value of this land at the time of transfer is 40 million rupees. What is the consideration on realization? Generally, the consideration would be the market value if they're associates. But in this instance, this specifically falls under the reliefs that were discussed before, where an individual gives the land to an associate. So in this instance, the consideration would deem to be the net cost. That would be 4 million. So there will be no gain on this realization because consideration is equal to the net cost, and there will be no tax payable. The cost of the transferee will be deemed to be the same amount, which would be 4 million in this instance. Let's move on to the second illustration. So in this illustration, an individual gives shares to his daughter. So note here that this is not a land or building, but this is shares. So in this situation, the consideration would be the market value of these shares, which is 250,000. The gain on the realization would be consideration minus cost, that is 250,000 minus 100,000, which was the cost at 2018. The tax payable would be 10% on this 150,000, which is 15,000. The cost incurred by the transferee would be deemed to be the same amount, that is the market value, that is 250,000. As Amma discussed previously, there are also exemptions on these capital gains. The law has specifically recognized the following exemptions. If there is a gain made by a resident individual on the realization of the principal place of residence, for example, where he lives in, provided that he has lived in that house for the past 2 years and he has owned that house for 3 years. Any gains on the disposal of that property would be exempt from tax. Secondly, if a resident individual realizes an investment asset that does not exceed 50,000 rupees per asset or 600,000 per year, then that would be exempt. However, if the gain exceeds this amount, then the entire gain would be taxed at 10%. Thirdly, if any gains are made by a person holding shares in a non-resident company of more than 10% or more, and has controlling voting power of that company, then the realization of such shares, the gains made by the realization of such shares will be exempt from income tax. Further, any gains made from the realization of listed shares are also exempt from income tax. Moving on, this was brought about by the amendment to the IRA. This is where a property is transferred to a REIT, that is a real estate investment trust. This is basically an entity that owns and operates income-producing real estate. So if you transfer property to a REIT, then the gains would be exempt from income tax. Further, if you're a REIT holder, that is, if you're a shareholder of that REIT, then any gain that you get on the sale of units would also be exempt from tax. Moving on, any sovereign bond earned by a non-resident person would be exempt from, the gains on this realization would be exempt from income tax. And any gains derived by a commercial bank or an authorized dealer who has made an investment of not less than 100 million USD in international sovereign bonds issued by or on behalf of the government of Sri Lanka, the gain of such realization would also be exempt from income tax. Let's move on to an illustration. So in this illustration, an individual makes gains in June 2008 of amount 30,000 rupees on a sale of shares. He also makes 10,000 in November 2018, 575,000 in December 2018, and 10 million in January 2019. But this is on the sale of the house which he lives in. This is that exemption that we talked about. So what is the tax payable in June 2018? There is no tax payable. Why? Because he did not exceed 50,000 rupees for that particular asset. What is his tax payable in November 2018? Again, there's no tax because he hasn't exceeded 600,000 for that year yet. What is his tax payable in December 2018? Here, if you add up all of the gains, you will get an amount of 615,000. So this has exceeded the amount of 600,000, which means this would be taxed. The gain arising from this realization would be taxed. So what is the tax payable in January? That would be 615,000 rupees. The tax payable would be 10% of 615, that is 61,500. Moving on to the compliance requirement, if there is a taxable income consisting of a gain of a realization of an investment asset, then that person should file a capital gains tax return within 30 days after the end of the relevant calendar month in which the realization occurred. And the payment of tax in this regard should be done before this date, before the date on which the return is due. Before we move on to the conclusion, Jivanti, are there any questions on this section?
Yes, Divyana, we have a question in line. Shall I read it out for you?
Yeah.
Yeah. The first question is regarding the buildings. The building is classified as capital assets, whereas it is also said the depreciable assets are excluded from capital assets. If not building depreciable.
Jivanti, do you mind repeating that question?
Yes, sure. Building is classified as capital assets, whereas it is also depreciable assets are excluded from capital.
Yeah. So the definition of capital assets includes buildings, but on the same hand, it excludes any depreciable assets. So if the entity concerned, if the building concerned, the first test to check is whether it is a depreciable asset. If it is a building that you're using in the production of income, then it will qualify as a depreciable asset. So you treat it as a depreciable asset. Because depreciable assets are scoped out from the definition of capital assets, it will no longer be treated as a capital asset or an investment asset. I hope I answered your question sufficiently.
Yes. Shall I read out the question here? If a company has 2 or 3 businesses, like let's say rental, manufacturing, or any other value-added services, how can we separate investment asset? Question for you.
Is it with regard to income or the asset concern?
Asset concern.
So if you are to identify if an asset is an investment asset, so you will have to go back to the test that we discussed. First of all, to be an investment asset, it has to fall within the definition of capital asset. And then you check whether it is held for investment purposes. So what are the tests we use to check whether it is investment? What was the intention at the time of purchase? The frequency of transactions, for how long it has been held, how it was financed, and lastly, and importantly, whether there is an effective connection to the business. So if you have any doubt, you can start with whether there's an effective connection to the business, whether this asset has an effective connection to the business. If there is, then definitely it is a capital asset. Otherwise, you can use other tests to determine whether the asset concerned is capital or investment. So that is the general guideline in regard to determining whether an asset is investment or capital.
Okay, Amma, we have another question. If a company sell the investment asset in partial, then how can a company allocate the cost to the partially sold asset?
Partially, it is partially used for investment, partly for business purposes.
Business, yes. Then how can company allocate the cost? That's the question.
Yes, there are specific provisions in the law dealing with this. If you're looking at business and investment, you're looking at 2 different sources of income: investment income and business income. So the law says that you have to apportion the cost and also the consideration based on the market value of the asset used, or at least the parts of the asset used for the two different sources of income. So it's a case of apportioning the cost proportionately based on the share of the asset, market value of the portion of the asset used for that particular source of income.
We have two questions. One is it possible to set off the capital loss against capital gains in Sri Lanka?
Capital loss against capital gains.
In Sri Lanka, yes.
If it is a capital loss arising from a investment asset, no, you cannot deduct it against any other taxable income.
Another question. If asset is transferred to charitable institution, then is there any tax liability on taxpayer in case of capital gain?
There is a relief given if the transferor is an individual and the transfer to the charitable institution is made as a gift. That is, it is not a sale, but you're just gifting it to the charitable institution. In that case, I think Divyana took us through those provisions. In that case, there is relief given and the transferor will not be taxed because he is deemed to be getting the cost as consideration. But if it is a company which was transferring it, then there may be tax implications because this relief is only given to an individual.
Got another question. What is the tax implication on business transfer in Sri Lanka?
What was that? Sorry,
The question. Shall I read it out for you, Amma? Again.
Please,
What is the tax implication on business transfer in Sri Lanka?
So when you say business transfer, if the question is with reference to a transfer of business as a composite transfer of assets, or even as asset strip where individual assets are transferred to another company, then there will be realization aspects. In regard to all the assets that have been transferred individually, there can be implications and it needs to be checked.
That's all, Amma. We don't have a question in line. What is your plan? You want to move ahead or?
Yeah, let's, if it looks like there are no more questions and we've cleared everything, we'll proceed to conclude.
Yeah, sure. Okay, go ahead.
Okay, thanks a lot, Jivanti. So let us quickly recap before we wrap up. So we started with the concept of realization. So to talk about tax implications, first there has to be a realization of the asset, that is generally a transfer or a sale, which triggers this taxable event. Thereafter, you have to decide the type of asset that you're dealing with. Is it investment asset, capital asset, or a depreciable asset? In the case of a capital investment asset, the gain, as we discussed, is the amount you receive, but it cannot be less than the assessed value. The cost, if it is an asset held that you held as at 30th September 2017, you can use that date cost. Otherwise, it will be the actual cost incurred. In terms of rate, it will be taxed at the lower rate of 10%, both in the hands of the individual and a company. Moving on to capital assets, just to recap, consideration would be the amount you derived, or if it is consideration in kind, the market value there. and the difference between the actual cost. The rate would be the standard income tax rate of 24% generally, or if it is an individual, the progressive tax rates of 6% to 18% can apply. In regard to depreciable assets, if there is a transfer of any of these depreciable assets, the gain will be consideration minus the tax written down value, and again exposed to tax at the standard rate of 24% generally, unless a concessionary rate is applicable. So we'd like to leave with you a few aspects that you need to consider when approaching this subject. One is the type of asset you're dealing with. The distinction, specifically the distinction between investment assets and capital assets, it is a somewhat complex area. So you can use the tests that we've discussed. And first, you will need to identify the class of assets that you're dealing with. Specifically, because there are specific relief given in regard to gains on investment assets or capital gains. Then you need to also take into consideration the relationship between the parties who are carrying out the transaction. If the transaction is between associated parties or related parties, you keep in mind there are specific provisions governing such transactions. Also, the applicable exemptions and the relief, specifically the tax over provisions, need to be kept in mind. And we also like to leave with you that when approaching the subject, that you need to be proactive. That is, plan ahead before the transaction actually happens. You may want to reach out to your tax consultants. So that is it from our end. I hope we have covered the bases and taken you through aspects of realization of assets and the tax implications that can arise in Sri Lanka. Thank you, everyone.
Thank you very much. Can you hear me? Am I audible?
Yes, you are.
Yes.
Okay, all right. Thank you very much. I think interesting session. But did you notice that all the speakers, the panelists today, were women? And you know, it ties up very well with the international women. They all were, although it was not deliberate, but ACCA truly believes in gender equality, and therefore, coincidentally, today we had a session delivered by all women from our Sri Lankan team, the ACCA Sri Lanka, the EY Sri Lankan team. So I think on that note, let's close our session for today. Thank you very much, all the presenters, and thank you for the presentation, for the valuable information shared. Just for everybody's knowledge, we are now also exploring discussing cross-border taxation with the wider ASEAN region as well. So this is something that I will probably be picking up with Roshni later on, but that's the beauty of it, that this initiative has started just between Sri Lanka, Pakistan, Bangladesh, now is going to hopefully extend beyond the region as well. So Roshni, something for us to discuss later on and for us to ponder upon, but that's the news that I wanted to share with the rest of the participants as well. Thank you very much for joining in, and with that, it is goodbye from us. Thank you very much, and see you on Thursday now. Take care of yourselves.
Thank you. Have a good evening.
Bye.